Hello everyone, we are from Group A5 and today we will be presenting our assignment 2. For our analysis, we are pricing a call option on the ABMK Asset Index with expiry in September 2026. So for the current spot level is 1683.07, taken from the ABMK Asset closing price, and the strike price is 1720, sourced directly from the Bursa Malaysia option chain, and time to expiry is approximately 0.3315 years, and the market price of the option is 13.1 based on the last done price as no live bid as was available, and the risk-free rate is 2.96% derived from 3 to 6 month Malaysia Treasury bills, and the dividend yield stay at 3.89% starts from the FTSI Russell Index fact sheet. So for the volatility, we use a historical volatility of 9.22% calculated as the annualized standard deviation of daily log return over a 1 year look back period. So what interesting is that our option is currently out of the money because the spot price is below the strike price. So in the next session, we want to explore like what actually happened to the black skull price when the option is out of the money.
Next is theoretical valuation part. Firstly, we need to calculate call option price using the Black-Scholes formula. This is the result from Excel. From the calculation, we can see the theoretical call option value using BS formula is more than the actual market value. The option is 42% undervalued by the market. So why is the market price lower than the BS model price? The BS model assumes a perfectly frictionless continuous market where we can buy or sell any amount of options instantly at theoretical price. In reality, the OKI market suffers from limited liquidity. Investors and market makers will experience significant risk, thus they will demand a liquidity discount, making the market depress the price. The BS model also uses historical volatility which looks backward. However, the market is forward-looking. If participants believe the equity market will experience a low volatility period between now and September 2026, they will price the option using a lower implied volatility. A lower expectation of future variance naturally pulls the market price. The BS model also assumes a continuous smooth dividend yield. In reality, index constituents do not pay dividends continuously. They pay in discrete lumps on specific X dividend rates. If the market expects a major cluster of dividend distributions during the option's remaining time span, the market will price the call option cheaper because call holders do not receive dividends and index drops hurt call values.
For the next part, we will be presenting about implied volatility. So for this part of the assignment, we use Excel GoSeek to find the IV by setting the objective to change the BS call price, which was calculated using Black-Scholes formula, to be equal to the market price by changing the IV value. So from the results in Excel, we have IV equals to 0.06927, and the difference between historical volatility and IV is about 2%. Using the IV value calculated earlier, we then did a price simulation using our software. So using the simulation that we did, we then found that the price at maturity is 1698.73 and the 95% confidence interval is between 1245.81 and 2261.
Next, for the sensitivity analysis, first we find the ND1, N prime D1, ND2 and N prime D2 for the theoretical grids and market implied grids by using the normal distribution function in Excel. The first grids that we're finding is the delta by using this called delta formula. We can see that the market implied delta is less than the theoretical delta, which suggests that under market implied condition, the call option is less sensitive to immediate movement in the underlying asset price. As a result, the option price does not increase or decrease as strongly for small changes in the underlying asset compared to the theoretical model. Next, we find the gamma by using the call gamma formula. We can see that the market implied gamma is more than the theoretical gamma, which indicates that the options delta is more sensitive to movements in the underlying asset price. This means that the small changes in the asset price can lead to larger adjustment in delta under implied volatility compared to the theoretical case. This also suggests that the options has greater potential for rapid changes in sensitivity as the market moves.
Now let's look at Vega. The Vega based on implied volatility is higher than the theoretical Vega. Vega measures how sensitive the call option price is to changes in volatility. A 1% increase in implied volatility is expected to increase the option premium by about 346.37, while a 1% decrease will reduce the premium by the same amount. This indicates that the option is highly sensitive to market uncertainty. Next, both theta values are negative, meaning time decay works against a long call position. Every day that passes without a significant upward movement in the underlying index reduces the option's value. Therefore, a long call requires the index to rise quickly enough to offset this daily loss. Conversely, for a short call seller, this time decay becomes a source of profit as the option gradually loses value. Finally, the implied volatility rho is higher than the theoretical rho. Rho measures the option sensitivity to a 1% change in the Malaysian risk-free interest rate. If interest rates increase, the call option premium rises. If rate decrease, the premium falls. Call options benefit from rising interest rate, because investor can delay paying the strike price while gaining exposure to potential price appreciation.
This analysis, I first perform a validation of the put-call parity relationship, which is a fundamental principle of the arbitrage-free pricing. Using our parameters for the 1720 strike, the left-hand side of the equation, which is the difference between call price and the put price, it gives negative 41.70 points. And when we calculate the right-hand side, we subtract the present value of the strike from the dividend adjusted spot price. We also get the same value, which is the negative 41.70. So this mathematical alignment confirms two things, which is the first one is that our Black-Scholes model is consistent, and secondly, that the options market is efficient, means there is no arbitrage opportunities exist between these call and put contracts. Time varying volatility. So Black-Scholes formula assumes that volatility is constant, but in real world, it is not like that. Based on the previous calculations, the historical volatility is 9.22% and the implied volatility is 6.92%. So we minus those two and we get 2.3%. So this means that the volatility is dynamic, and it means that while the index has been somewhat volatile in the past, market participants currently expect a period of relative stability into the next 3 months.
Based on our result, the Black-Scholes model estimated a price of 18.59, while the actual market price was 13.10. This means the theoretical value was higher than the market value. We also found that the implied volatility was 6.93% compared with a historical volatility of 9.20%. This strikes that investors expect lower future volatility than what was observed in the past. Using the implied volatility, the expected FBNKLICI level at expire was estimated to be around 1,699.67. In conclusion, the Black-Scholes model provides a useful benchmark for option valuation. However, the difference between the theoretical price and the market price strikes that factors such as liquidity and market expectations may affect actual option price. Therefore, the Black-Scholes model should be used together with market information when evaluating options. Thank you.